What's up YouTube? It's Todd Horst here with Tasty Tracker. Today I wanted to talk about profit taking. This is one of those topics that you see a lot in the forums like Reddit, whatever, for newbies trying to figure out when they should exit a position. And then you especially get this if you are following any gurus. You will see all of these people taking the positions the guru takes blindly, and then they don't know when to exit because they didn't come up with the trade idea. So I don't have a problem with following gurus. I publish my own trades for people to follow, but you should understand the trades you're taking, and you should see that guru's trades as trade ideas, not as what you should necessarily take. So the members of our site, of my site, Tasty Tracker, can publish their trades as well. And it's very common that will alert me to a good trade idea, and I won't take, half the time I won't take the exact trade that one of the members took. I'll take a version of that trade, but it's really using your community and your peers to come up with a good idea, but something that fits your personality. But you take what they've done, you reassess what their assumptions were, and then you decide for yourself whether that's something you want to take or not. But then you know what your exit and your entry is going to be because you use their trade as an inspiration, not as the core idea, or it's still your trade because you put your own spin on it. Okay, so anyway, let's move on. So what I'll cover, selling to open, buying to open, those are different scenarios. Most people, when they're starting off, they're buying to open. And it's a little bit more obscure what profit level you should take when you're buying to open. Selling is much easier, that's why I start there. And then I've got general tips and some hard numbers and a visual example. So hopefully you can stick with me as we go through that. So what do beginners want to know? They're always asking, should I close this position? Should I close this position? And then they'll give you some of the details, usually not all of them that you need. And then they'll say, at what ROI, what risk reward should I be entering these positions as? And so, they're just looking for general advice, which, everybody was there at one point, so I'm not ragging on them or anything. But this video is hopefully meant to help those people to not ask those types of questions. So when you ask those questions, you get a lot of answers like, I would, or no one ever went broke taking profits, but sometimes you will get the let winners run. And I'm actually a fan more of the first two because it's encouraging people to take money when they are profitable. Letting your winners run is not bad advice, but to a new person, they're going to hold on to a position hoping that it continues to become more valuable, and then they'll end up holding too long and it will go against them. So as a beginner, I would definitely recommend taking your profits when you see them. It is true that you can't go broke taking profits, so take your profits early and start to build your strategy. Now, it might not be profitable at first because your strategy might be dependent on letting your winners run, but at least it'll get you used to getting the motions and coming up with your strategy, and then it will become evident like, oh, if I held this longer, it would have I would have been positive on the week. So you will see those kinds of things develop as you're logging your trades on our site for free. Then you will see that kind of information, and you can adjust your strategy as necessary. But for beginners, again, definitely I would take profits when you see them. So anyway, let's move on. It's impossible for anybody to answer that question because typically they don't have all of the variables that you do, because as a beginner you're not giving them all the information. So they might not know your exact fill strike quantity, what your thought process was. They definitely don't know what your risk tolerance is, and they probably don't know what your account size is. And that last one is actually way more important than what people, especially beginners, are giving credit towards it, because you should only be allocating a certain percentage of your account to each position. Beginner mistake is to allocate basically your entire account to each position. And so then if that's the case and you have profits, take the profits, because if it does go against you, you've now blown up your entire account. Again, that's not something that most people say, oh, I bet my entire account on this position. Well, that changes everything, because now I want you to take profits. If it truly is 3 or 5% of your account, let it run, because who knows, you could get an extra $100 off of that position, and that's a decent increase. But if it's a huge percentage of your account, you don't want to risk it. So yeah, that last bit makes all the difference in the world. The person answering it may not be as familiar with the stock as you are. They might not believe in that stock. Maybe you're a Tesla fan and they are not. They might not have given it a proper look over, giving it the actual time of day to sit down and analyze it. I could almost guarantee that that's the case, because nobody's going to want to do your homework for you. The market takes work, and so yeah, I don't mind looking at somebody's position, but am I going to give it the same attention that they would when it's their money invested? No. Maybe they're trolling you. You know, trolls are something that we all have to deal with, especially the more public you are, and so maybe they're just being a jerk and want you to lose your money. Maybe they're not good investors. You're asking somebody assuming that they know more than you. Maybe they're beginners. Maybe they're not beginners, but they're just terrible. There's plenty of people that have been investing and trading for years and years and years and are still not good traders. So that doesn't mean, you know, they could say, whatever, I've been doing this for 10 years. Okay, well, that to me doesn't mean anything. Are you actually good at what you're at trading, or have you been barely breaking even? And the last point here is they're not going to be invested in your success. Ultimately, at the end of the day, if you lose your money, they don't care. It's no sweat off of their back. So why would you put your faith in some stranger on the internet? Also, at the end of the day, it's the market, so anything could happen. You know, Trump could tweet something, the company could have extremely bad earnings out of nowhere, or have some kind of CEO controversy, something like that. So nobody can predict anything. If you put all of your faith in somebody trying to predict the future, and then it goes wrong, what's going to happen? Are you going to blame them? Are you going to blame the market? Are you going to blame yourself and use it as an opportunity to grow? These are all important questions, because the first two there, you're not taking responsibility for yourself, and you're not going to improve your trading strategy. You're just going to maintain the status quo, and then next time it'll happen, and then next time it'll happen, and then next time it'll happen, and eventually you'll blow up your account. So you need to use your experiences to evolve. Okay, so the first one I'm going to start with is selling to open, and I'm starting here because it's so much easier from my perspective to know when to take profits, and that is the beauty of selling. So the second bullet point here, I say intelligently close at 50% of the premium collected. That doesn't mean be smart and close at 50. That means close at 50% most of the time, but make intelligent decisions based on where your position is at that time before you want to close out. So basically what I do is I enter a position and I'll go ahead and set up the 50% closing order. But then as we go, as the market moves, if it's moving against me, if it's moving in my direction, if it's just staying stagnant and it's taking way longer than what I expected, so typically my positions close in about 15 days. And so say we're 30 days into a position, that's going to change, and I'll adjust my sell level or my close level because I sold to open. So I'm buying it back to close it, but I'll adjust my close level based on the events of the market. So it's not every day that I adjust it. Maybe once a week or something like that, I'll reevaluate, or if something noticeably goes against me and I change my assumptions. Okay, yeah, that's probably the best way to say it. If something changes your assumptions, then I will shift my closing order. Okay. So first major point here is to be aware that as time goes on, your risk to reward shifts. So you need to always, every day, evaluate your position as if you're entering it on that day. So say you're already up 50%. So you risked 350 originally to collect 150. That's a very standard setup for selling premium. But you're 10 days into your trade. It was a 45-day to entry. That's what most people recommend, what I recommend. So you've got 35 more days before your position expires, and you're already up at $75. So would you enter that same trade today with a 425 risk, $75 reward? It's very, very doubtful. That's way too little reward for your risk. If you do that consistently, you'll have a very high win percentage because you're choosing far out of the money options to sell. And so you'll have a huge winning percentage. You know, you'll get 95% win rate. But then something's going to happen, come along, and because you've risked so much for so little, it will end up blowing your account up in an extreme event because you've got so much collateral out there. And then when you have a series of losers, it will be enough to take you out. So it is a balancing act on how much risk you want to take. Okay. And then the note there too is that since this is further out of the money, it decreases in value slower. The Greeks are affected the further out from the stock price you go on either side. So there's still extrinsic value there that won't go away until it gets closer and closer and closer to expiration. So remember, we're still 35 days from expiration in this example. So there's still plenty of extrinsic value, and it's not going to continue to decrease at the same pace that it decreased in this first 10 days. You got lucky, there's a big move up, and so that's why you got that initial 75, but it's not like in another 10 days you'll get the final 75. It won't do that because there's still extrinsic value in there. So you might get an extra $5 or $10, but there's a pretty hard cutoff there where it's not going to decrease to zero. So this supports the idea of closing early. So say you got 30% in the first 2 days, you might want to consider closing early because not only will you probably got that on an overreaction, so the value that maybe you sold a put spread like I typically do, the stock shot up, you got 30%, and on that stock shooting up, that's typically an overreaction. So then the following days, it's probably going to creep back down, and you'll end up with in a couple days, it'll only be at 15%. So had you closed at 30% in those 2 days, you could have moved on to another position or waited a couple days and then re-entered the same position and collected more premium. So this first section here is all about things why you want to close early. On the flip side here, you also have to be aware of the days to expiration. So and again, this is a balancing act. If you're nearing expiration, theta will really kick in and begin to eat away at your position at an increasing rate. There's less time for it to swing against you, so it's the percentage in the money is going down every single day. So, 10 days to go, it's got a 40% chance, and then at 8 days, it's down to 30, and then at 5 days, it's down to 20% chance. So it's the likelihood of the stock moving that far is getting slimmer and slimmer and slimmer. So here's an example. If there's only 10 days left and you just now hit 50%, maybe IV had been high, or maybe the position had been against you for the majority of the time. Those are both common situations. But there's only 10 days left now, and you just now hit the 50%. You could close, but you've spent 35 days to make 50%. And I would argue at this point, assuming your percentage in the money is good. Now, if it was like 50% in the money, I would close it with the 50%. But say it's 30% in the money, chances are you'll be fine. Maybe there's a support level there for your stock. Then why not just hold it a bit longer and you can get 75 to 80%. You should still close early, but maybe holding it down to 7 days to expiration will get you that extra 25, 30%, and that's a really good return on investment because you just hold it 3 or 4 days longer and you make an extra 25% compared to the 35 days it took you to get that 50%. After a certain point, then it goes back to sort of the first point here where now we're down to 3 days, and maybe it is a high percentage in the money, is still hovering around 40 or 50%. There again, the risk, it's too risky and the reward is not worth it, so I would close it, and that's why I say still close early. So again, this is all about balancing these two. Okay, so buying to open is what most people start off with, and because they're starting off with their super lax in their ability to create a plan, maybe they don't know enough to create a plan, but that is what all this video is about. So the point is, if you're asking questions like this, you've been told you need to have a trading plan before you enter a position, and yet most people still don't have that. And I'm not saying you necessarily have to write it down. I don't write that down usually, but I did when I started. And so it is a good exercise to do that. There's a notes section in Tasty Tracker to put in your thought process that you had at the time of entry, so that way you can elaborate on that and contemplate that going forward. But most people still aren't doing that. So you need to choose your strikes based on your assumptions. That's another thing. People are very commonly buying what they can afford, and you might get lucky doing that where the stock moves up enough. So say you're buying a call, which is the typical. Maybe the stock, you got lucky, you bought this cheap YOLO lottery ticket, and the stock moved up good enough to increase the value of your bought call, your long call. But chances are it's so far out that it's not even going to increase in money. Remember what I said earlier, the further away from at the money strikes, the less the Greeks are going to affect it, which means it will take longer to increase in value until that strike gets really, really close to, until the price of the underlying gets close to your strike. So it's much, much better to come up with, maybe analyze the chart, and I'll go over this in a second, analyze the chart and come up with what your assumptions are, and then buy your strikes based off of that. Okay, so third bullet point here is when you sell to close the position, you want to do that into strength because there's elevated premium there. So if the stock chart moves up and then comes back down, and you don't close till it's down here, the value is, it's not just that you missed the top, but you also missed the direction. So you want to be closing your position into the strength, so that way you can close it quickly and for an elevated premium, much, much higher than, okay, so maybe I should say it this way. Say you can either close your call in Apple as it's going up to 100 or coming down to 100, and which one is better? And the answer there is obviously going up to 100, because at that point people aren't sure if Apple's going to go to 200 or 300, so it's going to blow right through 100, and you can get a high premium. Now on the reverse, as it's coming down to 100, people aren't sure if it's going to go to 50, so they don't want to give you a good amount for your option, because it could be worthless in a second. So you might be able to close it, and you might not even be able to close it to find a buyer because nobody is interested in that strike anymore because it could be going much, much lower. Okay, hopefully I didn't make that too convoluted. In general, though, I think you should ignore the ROI. If it's green, if the stock hit your target price, then just close the trade. So I'm going to go to an example here. This is Microsoft. This is Saturday, 7/18. So I just grabbed this chart. This is a fresh chart. So I'm looking at this chart. To me, this is a pretty good setup. It's been forming a base here for 2 days, and we even came down and touched this point 4 days ago. The purple line is the 20-day SMA. This is the 50-day SMA, the yellow. So we've been forming a base here roughly for 4 days, but definitely been consolidating good for 2 days. If we look back historically, just in the past couple weeks, we can see that it likes to consolidate here for about a week, or 10 days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Look at that, 10 days. Okay, so it's staying in these range for 10 days. Here it probably stayed in this range for 20 days. And then here again is 10, and then this is the recovery after COVID, so you can probably discount that a bit, but yeah, so we can see here we're forming a base. We like to consolidate for about a week and a half. So where could this go? Certainly it could go down, but let's assume that I'm bullish on Microsoft because I am. So I'm going to want to buy to open something in the 210 to 214 range, okay? I'm looking at the top here. It says 216, roughly. So getting something just below that, right now we're sitting at 202. So 210, is somewhere in here. 214 is pushing it, but it's going to be right up here. So getting somewhere in there, I think, is feasible. What you want to do is hopefully have your call become in the money. So you buy something that's out of the money and it becomes in the money as your price, as the stock goes up. So you have to ask yourself a couple questions here. How high do you think it's going to go? I would assume that it would come up to 216 and then it's probably going to get rejected, and think about it, whether it actually wants to go up again. And then it might come down or it might blow through, but I'm pretty sure it's going to hit 216, at least touch it. So I want to get something below 216 for sure, and then when it's getting close to 216, I want to close it. So then the next question is how soon? Well, before I said, this was about a week. These were like 2.5 weeks. So sort of I don't like doing the week of expiration. That's way too soon, and 9 times out of 10, those end up not being profitable. And then that one time, it will be extremely profitable. So if you were to choose that as your strategy, your account is going to go all over the place because 9 times out of 10 you're failing. So most people would, at least for the short swing or day traders, most people like to do around 2 weeks expiration. If I'm planning on holding the call for any sort of sizable amount of time, because I'm fighting against theta there, which if you don't remember that, you can watch my Greeks video. But I would rather even go out something like 60 days to expiration to buy. However, again, as it's always a balancing act, the further you go out, the less it's going to be affected by a move in the stock. So maybe we'll choose, I have 14 days, but maybe it would be a little bit safer to go with something that's around 21 days, 21, 30, somewhere in that range, expiration. Okay, so let's say I'm going to buy the 210. When it gets up here to 214, 250, I'm going to close that, and it's going to be around 25 days, 30, somewhere in there to the expiration. So I actually changed my mind on that one a little bit. But that is a trade idea. It's not something I'm going to enter myself because I don't buy calls, but at least not most of the time. But that is an idea that you might want to consider if you can afford it. And then if you can't afford it, then you're going to need to start moving to lower cost stocks. So this is a $200 stock. Most people starting off might want to play something like AMD, which is around a $50 stock, Twitter, those kind of things, which are cheaper, and you're able to buy something. But the setup and the concept here is the exact same. It would just you just have to make it applicable to whatever stock you're looking at. So conclusion here is, with any strategy, typically holding longer can tend to increase your profits, but it's at the expense of stability. So it's a balancing act, as always. How many times have I said that this video? So the more money you have in your account, the less money you're risking per position, the longer you can tend to hold your positions to eke out a little bit more profit, and you might see an increase in your ROI, your account growth month over month, if you can do that. But if you have a smaller account, I would say it's not worth trying to eke out that little bit of extra profit unless it's critical to your strategy. And just close out the position when it's profitable. There are always trade-offs, and you have to find what aspects you value and then build your strategy around that. So I have a full-time job, and I don't like staring at the charts, and I like the concept of time eating away at the value. I believe the market trades sideways the majority of the time, or within a range. And so all of these things lead me to selling spreads. I also believe the market generally goes up, and I believe good companies will continue to be good companies. Those are all key aspects of my strategy and why I primarily sell put spreads. And so I've taken my personality and my needs and desires, and I put that into a strategy, and that's what I've come up with. But everybody's different, and I'm not looking to get rich in a day. I'm looking to be profitable, more profitable than what just putting it in some index funds could get me, or letting somebody else manage it could get me. So those are my desires, and ultimately you need to find out who you are and how you want to trade, and that will dictate your strategy. Bind to open requires precise timing. You need to be directionally correct, and then you need to monitor to close it, and you need to be accurate. Like I said, they're selling into strength, and all of that is very time involving. I don't have the time to sit down and watch the markets all day. I have other things I need to take care of. And most brokers that I'm aware of don't allow you to close your option position when a stock hits X value. I know there are some, and you can do some scripting, but I don't think that's built into most platforms. But that's really how I think you should be playing those positions. So what I'm trying to say there is, you can set up a closing order when you buy to open, but you're sort of taking a stab at what the actual value is, what the ROI is, or the increase in value is going to be at that point. And I personally don't believe that, at least at this point, that that's as accurate as watching the chart, and when it's getting close to a resistance, then closing out your position. I think that's a better way. But then again, you have to be watching the chart. So if you can't, then buying to open is a little bit tougher, and you have to guess, and that guess might not get hit, or it might not give you as much profit as if you could be watching it. On the flip side, selling to open is very, very easy to put in the closing order at the time of entry. So you open up your position, you sold the put spread because you believe the stock is going to go up, and you know right away what premium you collected and what 50% is of that. And then once a week or whatever, you can adjust if your assumptions change on that. And you can do that after market closes. So it's not something that where you need to stare at your screen and trade very actively. The main point though to any of this is you need to have a plan, you need to stick to it or evolve it as necessary, and then evolve your strategy as necessary. Anyway, that's all I had today. Hopefully this was helpful. Give a comment if you have any questions or video ideas. I do have a lot of ideas planned. I tried to do these Fridays, today's Saturday, but hopefully that's okay. I do have a free website where you can track your trades, and all of this is just my personal advice. Thanks, everyone.